Public First from Philadelphia a week and a half ago. And people are now concerned that for rates affecting the commercial real estate sector, if Powell wants to keep rates higher for longer, wouldn't that put more pressure on CRE and thus ultimately more pressure on the regional banks exposed to CRE? What's your take on the banking sector?
The CRE sector certainly is very troubled. This shows the sales price for office building in major US cities, and on average, the office building prices in US city has dropped by 16%.
Are we seeing the beginning of a banking crisis unfold this year? Can the commercial real estate sector survive rates higher for longer, or are we going to see it bust? Well, what happened to the economy if we get a population shock? And how will the Federal Reserve respond to inflation as it unfolds later on in the year? These are the themes of our discussion with our next guest, Anna Wong, Chief U.S. Economist at Bloomberg Economics. Prior to Bloomberg, Anna was an economist at the Federal Reserve Board, the U.S. Treasury, and the Council of Economic Advisors at the White House. Anna obtained her PhD in economics from the University of Chicago. This episode is sponsored by iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. If you'd like to learn more, to get started, click on the link down below at itrust.capital/David. And if you sign up using my referral link, you get $100 in sign-up bonuses. Anna, good to see you again. Welcome back to the show.
Yeah, good to see you too, David.
Let's start by talking about the Fed. So recent news first. A couple of weeks ago, Jerome Powell said this: policy is well positioned to handle the risks that we face. He said on April 16th, if inflation continues to run somewhat stronger, the Fed will simply keep rates at their current level for longer. So higher rates for longer. Is that the correct course of action, or is that a policy mistake?
Yeah, David, there are, I would say, currently three camps in terms of describing whether the Fed rate is sufficiently restrictive. The first camp are the MMT folks who think that, in fact, rate hikes serves to increase inflation as opposed to lowering it, and their prescription for lowering inflation would be to cut interest rate. The second camp is more mainstream that says that, in fact, the economy is very resilient to rate hikes, and that the level of Fed funds rate at 5.5% is never restrictive enough. The Fed needs to hike some more. And then there's the third camp, which is the Fed, what the Fed is thinking, and also where we are also at, which is that at 5.5%, Fed funds rate is just exactly restrictive enough. And the reason why they, at least Powell, and also why we thought that it was just restrictive enough was last year at around October of 2023, we saw that the economy was very close to tipping into a recession. And I think it will be a couple years down the line from now when we can decisively say whether there was or was not a recession in 2023. But in late 2023, things were looking dire. And however, Powell immediately staunched that early recession dynamics by making a very dovish pivot in December. Um, and that led to a big decrease in treasury rates and long-term treasury rates, and the economy, a lot of economic activity is closely linked to the long-term treasury yield. Think about the housing mortgage rates, the auto rates, the loan rates, and a lot of the term financing rates that corporates get. And so in the past 3 months, we see things improve or stabilize from when in versus late 2023, it was not looking like it was stabilizing. But I think that the Powell's December pivot was quite important in improving things in the past 3 months. So I think to your question, whether rates are sufficiently restrictive, it is, but the Fed has loosened it somewhat in December. I think looking forward, rates are looser than what it was last say October, and the Fed does need to tighten things a bit more if it wants to get back on track for disinflation.
And Powell, I think, did indicate that he wants to taper the taper, so to speak, which is to say that he wants to slow down quantitative tightening. Is it possible that the Fed will just do that and not lower rates?
Well, so from the Fed's perspective, the balance sheet policy is completely separate than controlling the Fed funds rate. I mean, when the Fed announced the tapering, what it ultimately aims for is to extend the period of the balance sheet normalization so that it wouldn't run into the what we saw in September 2019 when you have liquidity problem. The Fed wants to avoid that. So by going slower, by lowering the caps on the balance sheet runoff, they were hoping that they could conduct that, they could continue to run off the balance sheet all the way to as late as like well into 2025. So it actually is not as dovish as one thing. It means that they do really want to get the balance sheet into a trimmer size.
Okay, so ultimately, do you think that a rate cut is in order by the end of the year?
Well, I think Powell very much explained his reaction function. The Fed has a dovish and asymmetric bias. So he laid out two paths for rate cuts, which is number one, the economy is strong, continues to be strong, and disinflation continues because of favorable supply factors. In fact, this seems to be the Fed's base case. Powell mentioned immigration several times. The FOMC minutes from the previous meeting mentioned immigration 5 times. So they are basically betting that an increase in labor force could lead to what they call immaculate disinflation, that you have wage growth slow down and price slow down without an increase in unemployment rate. So the second path for which a rate cut is possible is if the economy weakens, unexpectedly weakens in Powell's word, and then the Fed will be ready to cut rates. And he didn't mention what inflation has to do in this scenario, but I think implicitly the Fed is thinking that if the economy does weaken, inflation will goes down as well. So when you think about it, any path, like even if the economy grows slower, as long as inflation cooperates, or even if the economy weakens, the Fed is ready to cut rates. What you didn't hear from Powell is that they're putting any weight on the idea that inflation could continue to be sticky even as the economy weakens. That is the scenario they don't have in their base.
Investors would like to know what indicators we need to follow for Fed guidance. In other words, what goalposts do we need to see or reach before we can have conclusive, I guess, evidence that the Fed is going to do one thing versus another?
So I think the most important goalpost is the core PCE inflation on a 12-month change basis. The core PCE inflation is currently at 2.8%. And usually between now and July is when you have all these favorable seasonal patterns. And right now we are seeing favorable base effects as well, because 12 months ago at this time, inflation level was high, right? So it actually helps to push the 12-month change lower. So, which is why from now to July, we, and I think the Fed, expect that the core PCE on a 12-month change basis will be edging down. And if that's what happens, I think the Fed, and also if we do see unemployment rate going to 4.1 or 4.2% before July, then I think the Fed will be ready to cut in July. However, one also crucial factor is that if what we are seeing in the core PC inflation in terms of the forecast is that in the second half of this year, the base effect will turn unfavorable. Seasonal patterns would be also unfavorable. We expect the 12-month core PCE inflation to drift back up to 3% towards the second half of this year. Now, if the Fed also see this, then even if core PCE were to edge down to 2.7% or 2.6% in July, they probably will not cut, because one of Powell's criteria for cuts is that they need to have confidence that inflation is on a durable, sustainable trajectory to 2%. So if the path is more like V-shaped and the inflation goes down towards the middle of this year and then drift back up, and they see it, they have that in their forecast, then they wouldn't cut in July. In fact, it would make it very hard for them to even cut in the second half. So, David, in other words, I'm saying that if the Fed were a really believe in forecasts and they are a perfect forecaster, they believe that inflation will drift back up in the second half, there's no way they can cut this year. But however, if they see inflation drifting down to mid-year and unemployment rate rises to 4.2%, they will cut in July.
Why has inflation been stickier than some have anticipated so far?
First of all, the that going back to the December pivot, we now have enough data. We have now 4 months of sorry, not 4 months, January, 3 months of inflation data to show convincingly that to see that the loosening in financial conditions through the stock market rally is showing up in inflation data. There's actually a category in the core PCE inflation that's financial management, portfolio management, and it has contributed to zero point 0.2 percentage point surprise, upward surprise in inflation this year. So just that component alone is super clear. We also see that in GDP data and like GDI data, there's a category that shows how much of the boost in final demand is due to income growth, primarily dividend growth. And there was this massive surge in dividend growth, which is linked to the equity rally. So for sure, the loosening in financial conditions through the stock market rally has translated to higher income, higher spending, and supporting the economy. So, however, in terms of the other parts of the why inflation is sticky, on top of that, there's also a second or even third round of catch-up inflation. We're seeing that in wages, for example. Wages actually does not cause inflation. Wages actually is actually a respond to a rise in prices, at least in the past 2 years. So early this year, we saw over half of the states in the U.S. raising their minimum wage, and that showed up in the first quarter employment cost index last week, which was hotter than most people expect, but we actually forecasted this hot CPI. And we were forecasting the second quarter ECI to be hot again because of California's fast food minimum wage hike, a 20% increase in April. And the Fed is going to get that data point in the second day of their July meeting. So if that is a hot number, I would think that July would be as well off the table. That would change the mind of people in cutting in July. So there's a lot of catch-up dynamic, like car insurance, home insurance increase. Car insurance is now 22% higher than last year. And that's because that reflects higher cost to repair cars. Cars are just more expensive to repair. And also labor is expensive. Everything is expensive. And it requires state approval to hike auto insurance, so is home insurance. So there are a lot of like lagging inflation that's still catching up to the past 2 years of high inflation.
And are we seeing a banking crisis unfold? I know that's a very loaded question, but that's something that people are wondering and concerned about. Certainly, we've seen the failure of one bank, Republic First from Philadelphia, a week and a half ago. And people are now concerned that for rates affecting the commercial real estate sector, if Powell wants to keep rates higher for longer, wouldn't that put more pressure on CRE and thus ultimately more pressure on the regional banks exposed to CRE? What's your take on the banking sector?
Yeah, so I think the CRE sector certainly is very troubled. And if you see, can you see the shared
Yes.
screen I
Yes.
showed? Okay. This shows the sales price for office building in major US cities. And on average, the office building prices in US city has dropped by 16%. And San Francisco is the hardest hit, dropping by almost 40%. So as the valuation of these commercial real estate properties plunge, that would affect the asset size, the asset part of bank balance sheet. And the concern is that with the drop in valuations on these CRE properties, it could lead to liquidity problems in banks. So here in this chart, we showed the results of a stress test that St. Louis Fed has conducted in earlier the year in the year. So the stress test is, what if there's a 40% drop in the valuation of commercial real estate? And I just showed you that the only city that's close to seeing that is San Francisco, right?
Yes.
Which is like close to 40. But so 40% drop in CRE valuations is a very extreme scenario. So this is, so here we show that the banks who would be going solvent or going failing versus the banks that will be seeing liquidity crisis. So the orange bars as a comparison point shows the what happened last year with the SVB and the in total I think 5 banks failed
Right.
last year, and that accounts for about 2.5% of total banking asset. So in this stress test scenarios, if there's a 40% drop in CRE values, then about the same share of banking assets would be affected. So almost also about 2.5%. But in terms of the number of banks involved, that's where the key difference is. Last year, the banks that failed were massive, and so only a few banks failed. 5 banks failed in 2023. But then in this third panel, we show the average size of those 5 banks, and it's over 100 billion. So of course, that's driven by Silicon Valley Bank.
Mhm.
However, with the CRE crisis, if there were going to be a liquidity problem, it would be just 10 banks that failed, more than last year. But the average size of those 10 banks would be much, much smaller than what happened last year. So if you look at this result, if the average size of the bank that failed is about 50 billion, it's not a systematically big bank.
Okay.
So it wouldn't have as much impact of like a banking crisis or bank runs like what we saw last year. However, what this would mean is more of it would, because the banks that would be failing as a result of the CRE crisis would be small banks, which is this orange line here, and we show the small bank lending versus large bank lending. So what this shows is that typically small banks contract in their lending in a downturn less than the large banks. So the large banks have to be have to follow regulations, and the Fed is in the next year or so will be proposing tighter regulatory rules for larger banks. So this is why in bad times during the economy, it is the small banks that support the credit conditions. And if the small banks are the ones that are going to be experiencing liquidity problems in a CRE situation, then those banks will be pulling back credit, and that would lead to a more decrease in economic activity than otherwise would be. Basically, it took away a slightly counter-cyclical force that supports the economy in a downturn.
Are you concerned at all about a loss of confidence in banking from even just a few small banks failing in the future, which may lead to a bank run just out of fear?
I think one should never dismiss tail risk like that. But I think the more likely scenario is that these small banks would be consolidated with larger banks.
Okay.
And as these smaller banks are consolidated, the regulations would be tighter, and it would be harder for folks who live in, say, rural America or in communities that rely on these community banks for, loan needs through personal relationships. They will lose that, and you'll see overall just tighter credit conditions everywhere, and that's
Okay.
bad for economic growth, obviously.
Yeah, yeah, that has an impact. Well, overall, then, does the CRE sector face considerable stress from higher rates for longer? In other words, can it survive higher rates for longer?
The CRE sector is facing a confluence of factors, both structural and cyclical. So the higher for longer rates obviously would be a problem, because it means that so right now the CRE sector is basically kicking the can down the road in terms of a problem. Each year they're seeking for the landlord to and the lender to postpone the rollover of the debt. And last year's supposed at first there was supposed to be over 600 billion that was due for refinancing, but they were able to extend it, kick it down the road to this year. And by being able to kick it down the road, it's they're hoping that maybe when the time comes for when they need to refinance, the Fed would have cut rates already. And so they could roll over to something more favorable. So you can imagine that if the Fed wouldn't cut, then the lender might be running out of patience. And
Right.
they're like, we can't extend this anymore. Things are not going to get better. And then that will be the time of the reckoning when you'll see default, and a lot of banks' balance sheet would be revealed in its nakedness of how bad it is, because when the refinancing comes, then their appraisal of the CRE property will reflect the market value, and it would just reveal how bad it is,
But that's not
once
happening
it's marked.
currently, today.
No,
Okay.
no, I mean, I don't think that's happening because a lot of that requires the it to be the refinancing to be happening, right?
Yeah.
So I think that's the one reason, but the other really major structural reason is just the remote working culture that, almost half of the labor force is still working remotely. And of course, that will change as the labor market get looser and
Mhm.
employers call the workers back into office.
Yes.
But it is a very slow moving thing, which won't suddenly go from, 60% work from home to 95% work from home. It doesn't work that way.
How's residential real estate holding up? I know that's very jurisdiction specific, but we could just take a broad stroke evaluation here. I know you're a host of the of Airbnb property. You talked about that last year on my show. How's that experience been for you over the last 6 months?
Okay, so of course, David, my data point is just one
Sure,
anecdote,
yeah.
but I think my anecdote, a lot of people felt a similar pain as my anecdote, but yeah, generally what I'm seeing is that the supply of Airbnb has increased because a lot of people who were working who because of the remote work policy during the pandemic moved away, and there was a lot of demand for these temporary housing a couple of years ago in more rural area because people thought that they could work anywhere. But now that people are being called into office, there's obviously less demand. And second, talking about sticky inflation, we just talked about how insurance's prices has been rising this year, in fact, driving the increase in the sticky part of inflation. And that's to a large part sticky catch up inflation in response to houses being higher cost to insure. Construction material is higher, labor cost is higher. So as a homeowner, one could see the monthly payment, the cost of home ownership rising significantly. So in my own personal anecdote, I definitely do see this increase in hidden cost of home ownership,
Mm.
while they're on the revenue side of Airbnb, you're seeing a significant decrease in demand, partly because of the decrease in remote working trend and the loosening of labor market.
I'd like to discuss now with you, a good segue. I'd like to discuss with you the impacts of housing shortages on broader economic growth and even productivity. This is an article that came out from Bloomberg actually 2 days ago. The headline is Global Housing Shortages Are Crushing Immigration Fueled Growth. It's a lengthy article. I won't read all of it, but there's some interesting analysis here. The first paragraph reads, across much of the developed world, one of the most dependable drivers of economic growth is faltering. For decades, the rapid inflow of migrants helped countries, including Canada, Australia, and the UK, stave off the demographic drag from aging populations and falling birth rates. The article then goes on to say that there's a housing shortage in many of these countries. There's another paragraph I'd like to draw your attention to. The chronic underbuilding of homes and decades of continuous rises in prices has drained funds from other parts of the economy toward housing. That lack of investment in capital, combined with firms focusing instead on expanding workforces due to cheaper labor costs, has driven down productivity. which the Bank of Canada says is at emergency levels. So several things to unpack here. One, the aspect of immigration not being, I guess, fulfilled in terms of the demands for housing, and the second, potentially an undersupply of housing draining resources from other sectors of the economy. Can we address these?
So even before the immigration surge, the economy was experiencing a structural housing shortage, as for the reasons that you just mentioned, David, which is that after the great financial crisis in 2008, firms were trying to deleverage the balance sheet, and as a result, construction was depressed for a whole decade after that. So in the lead up to the pandemic, the U.S. housing sector was probably 3 million underbuilt in terms of housing units. And now, on top of that, during the pandemic, going back to that remote work thing, so a lot of people who live in the urban center moved to more the suburbs, rural America, and they have driven up the housing prices in rural America, and as a result, making um, housing prices in rural part of the country more unaffordable.
Yes.
Um, and furthermore, if you look at the ultimate destinations of the migrants, so in the U.S. we have seen a 7 million increase in immigrants slash migrants between 2001 to 2023. And currently, this year is also on track to add another 3 million migrants. So, in total, between 2021 to end of 2024, the US likely saw a 10 million increase in immigrants, which is about 3% of the total population. So, if before the pandemic, you're already underbuilt by a couple million, and on top of that, you're adding, uh, 10 million of immigrants. So for sure, you have a housing shortage. And where these immigrants ultimately land is also a problem. It looks like that the four major cities, which are where the immigrants ultimately land in, is California, New York, Chicago, and I believe it was either Colorado or Arizona.
Mhm.
And these are the cities which have the most serious housing shortage problem because the real estate market is not national, it's local because all cities have their own zoning rules, they have different housing supply elasticity. And when you look at the pipeline of to be complete housing units across the cities, the picture looks very different. Of course, in New York, in California, you see this not enough housing supply. But then if you look to the south, like look at Dallas, look at Houston, look at a lot of places in Florida, in fact, there's a huge pipeline of multifamily units that's about to hit the market. And vacancy rate is also decreasing. But then the migrants wants to be in places like New York, Chicago, California. So the issue is how do you the ultimate allocation pattern of where the migrants ultimately land is a problem. Like if they want to go to rural America, there's plenty of place in rural America. The problem is rural America is actually encountering a brain drain. And in fact, population is decreasing in rural America. Nobody wants to live there.
Mhm.
And then we're going to live in the city. So I think this housing shortage issue facing the country is a very complex issue, and it's not clean cut to say that there's not enough housing. It's really about where are the migrants going. There are certainly enough housing for migrants elsewhere in the country. Is right. So I think it's a more complicated issue.
So ultimately, then, Anna, would this housing shortage issue have a drag on the economy, as this article suggests it may?
Well, so if you think about broadly how the economy respond to a sudden surge of population growth, our model suggests that on net in the short term it's a net positive demand shock, because of the demand for housing, demand for social service, demand for food. Um, it happened the moment the migrants arrived, right? But in terms of integrating them into the labor market, where they become productive members of the society and expanding the supply capacity of the economy, it doesn't happen until after a while. And nobody knows how long it takes before the migrant have work authorization to work legally in the country. They have a driver license, they learn the language, they can actually participate. So in between that time when they arrive and when they actually join the labor force is when the economy would experience higher inflation, higher unemployment, and the Fed funds rate has to be higher as a result to counter these inflationary forces. And at first, it may seem stagflationary. And this is kind of what we're seeing in the US economy right now. It feels stagflationary ish in a sense that inflation still seems to be stickier and the labor market seems to be looser. But then ultimately, once, according to the model, that is standard economic models, ultimately, once the new labor supply is absorbed, then there will be a boom in the economy. But prices will be permanently higher as a result of this, boom.
Okay, well, I want to finish up by talking about your research on population shocks. I think this may be a good segue to that. And like you told me offline and what you just said, the US is looking like it's entering some sort of stagflation. How does this tie into the population research that you were doing?
So I just want to put the word stagflation in quote. And
Sure.
as Powell says, he's neither the stag or the inflation.
Okay.
Well, I think I think first of all, I would not dismiss the word stagflation because 2 weeks ago when the core PCE number came out, the word stagflation was the most searched economic term on the internet, and there is a reason why people think that because clearly inflation is not coming down and many people are suffering from it. On the other hand, people are finding it harder and harder to find a job. And the other day, New York Fed put out a statistics showing that the people who are earning less than $50,000 a year saw over 20% saw a higher anxiety about job security. And I think that reflects the immigrant anxiety of these low skilled people because they will be directly competing with the immigrants. So I think that on net, I think the I think I do believe in our model results that the population surge would be a net positive demand shock for the economy. I think it will take longer for the economy to be able to absorb them, partly because we have seen a lot of minimum wage hikes in the past year. I mean, imagine, I just told you that um, immigrants love to come to California, and California's fast food has just imposed this $20 minimum wage hikes. It basically makes it harder for businesses to take advantage of the lower cost, low skilled migrants, right? Because of that $20 floor on fast food. And similarly, the overall state minimum wage, I believe, is $17. But if fast food is at $20, they will eventually have to converge to the $20 fast food. So it just like it means that there will be less demand for low skilled labor. Even though you could draw from this surge of low skilled labor, it means it will be harder to absorb immigrants. It means that the inflationary impact on the from the initial part of the population shock would last longer and the unemployment rise would last longer because it takes longer for these to the new workers to find a job. So I think this stagflationary feel of the economy will linger.
Okay. And does the economy need a population boom for either growth or productivity to catch up? Is that the issue here?
Yes, David. I think that the issue is about what type of immigration. So, and I'm speaking from a cold-hearted economist, right? This is what economic models predict. In fact, if you go on CBO's website, they have a model that you could play with about you could impose a shock on high-skilled immigrant as well or low-skilled immigrant, and it really matter what type of immigrant. So if it's a high-skilled immigrant, it boosts productivity, it boosts innovation, TFP, TFP growth, and overall, it definitely has a unambiguous positive impact on the economy. Now, with low-skilled immigrant, on net, it actually lowers labor productivity according to economic models initially, because the jobs that they will be adding to the economy or displacing in terms of other workers would be on the lower productivity type of jobs, and so it is I think also where the economy is seeing shortages of labor are in areas like healthcare, teachers, and I think the type of immigrants that's coming in, it will take a while for them to build up the human capital needed to contribute to the sectors which are experiencing the most heightened shortage. On the other hand, however, construction workers is definitely seeing shortages, and I think that will be a natural landing place for a lot of these migrants. But I don't think there's enough construction workers to hold all of them, because we're talking about 5 million increase in potential workers in the economy. I don't think there's 5 million increase in construction jobs this year, especially given how rates are higher for longer.
Here's let's finish off with productivity. So Canada, where I live, has been lagging behind the US in productivity since basically the dawn of time. But that productivity gap has widened in the last 4 decades. I don't know why. I don't have an answer to that. All I know is that the smartest kids in my, well, not all of them, but most of the smart kids in my graduating class in McGill went to Wall Street, right, south of the border. Not They didn't stay in Canada. Canada has always faced a brain drain problem. Productivity has always been lower. Why is that? How can a nation overall, especially an industrialized nation like Canada, improve productivity and ultimately improve growth?
You see, David, McGill is, congratulations for going to McGill. McGill is like a top tier university. And if Canada is just McGill, then Canada's TFP would be through the roof.
I mentioned my
And
smart colleagues and friends went to the States. Clearly I'm still here. But anyway, please continue.
and so what you're just saying is explaining why high skilled immigrants matter. High skills, if you think about human beings as carrying inside them a TFP unit,
Yes.
and the people who are graduating from McGill have higher TFP than a normal person, and they're moving to the US, so the people who are adding the marginal addition of TFP in the US is a high one. So this is why the US has been a bastion of high-skilled immigrants in the past. Everybody wants to come to universities here, and then after they studied here, they stay here, then return to their country, and so those are the great kind of immigration. But if you look at what you just described, Canada is kind of similar to rural America as well. The rural America is. I'm not saying that Canada is equal to rural America.
Okay. All
In
right.
fact, Canada is way better. Okay, I'm just falling into a hole right now.
No, no, I
But
understand the
however,
analogy. Yeah, there's
but
similar
however,
economic parallels. Yes, I understand.
right, right. But just as an extreme, in rural America, we're experiencing brain drain. And when you have brain drain, you have lower TFP. So in order to keep the best and the brightest, you have to have jobs for the best and the brightest. Now, I'm not sure that Wall Street jobs are the most that add productivity. I always say I provide no redeeming value to the society. That's how I explain to people in terms of what I do.
Is that what
I
you say
only
at the
make,
recruiting events?
oh yes, I tell people I just make rich people richer. It's
All right.
horrible.
Okay, but Anna, going back, so the jobs that are in the U.S. on average, especially for higher paying professional jobs, they pay more than in Canada. So is that all it takes to attract talent, higher pay, and perhaps lower taxes? Anything else?
Well, first of all, I wouldn't say higher pay, because higher pay would be, it could become a wage price spiral. You certainly don't want that. But no, I think it's economic opportunity and dynamism. It's about I think U.S. compared to many European countries has a more flexible labor market. So as a result, in every, in business cycles, in upside or downside, you see, especially during downturns, productivity really increase as firms were able to shed cleanse. So oftentimes the economic cycle serves as a cleansing device that lead to improved productivity going into another expansion period. And I think the U.S. economy has still maintained that dynamism that many other advanced countries don't have.
Is there anything else that sets the economy apart in the U.S. than, let's say, the Europeans, for example? What brings the U.S. economy more resiliency than the European counterparts post GFC and perhaps even post pandemic?
I think it's first of all, I would not extrapolate today's U.S. Economic outperformance to indefinitely. I think a big part of the U.S. Outperformance is our massive fiscal stimulus during the pandemic. And ultimately, there is a price to pay for that. The ending of that story has not been written yet. However, I would say that structurally, U.S. is a place where we have great universities, and that lead to more incubation of ideas. If you look at um, the places that lead to the impetus for innovation, it's often only concentrated in a couple of places. You only need a couple of high clusters of economic innovation to generate like life-changing, human civilization changing kind of innovation. And Silicon Valley is one of those places where you have a lot of great universities, a lot of great ideas where people come up with interesting ideas. I have not seen other. There's a city elsewhere outside of U.S. that can rival that kind of innovation with availability of private capital ready to channel an idea into a product. And I think that's an important reason why US still maintain an advantage over other countries.
Excellent. Where can we follow your work, Anna?
Ones, mainly my pieces are published on the Bloomberg terminal. If you have a Bloomberg terminal, then you can go to BECO, BECO Go, where all our analysis for the US economy as well as the global economy will be published there. Otherwise, you can follow my tweet on Anna Economist on Twitter or X.
Okay, excellent. So make sure to follow Anna in the social media links down below, and we will follow up with her again soon. Thank you for your time again, Anna.
Thank you, David.
Thank you for watching. Don't forget to like and subscribe.